Hello. Yes, I Chintan Gajjar. Welcome you all to the today's webinar. So, good afternoon to everyone. I would like to extend warm welcome to learned speaker of today's session, Sri Dhaval Trivedi, Director International Tax at KC Mehta and Company, respected seniors, fellow professional colleagues, and friends who have gathered on this online platform to attend session on new dividend tax regime and ocean of interpretations. So, as Albert Einstein once said, the hardest thing in the world to understand is income tax. Therefore, we have invited Honorable C.A. Dhaval Trivedi to make this much debated subject a little easier for us. So, I hope and wish that all of us you are in good health in this tough time. I would like to thank Sri Dhaval Bhai for accepting invitation and sparing his valuable time amidst his busy schedule. I am also thankful for the overwhelming response that participants have shown in attending the session on Sunday afternoon. That shows their zeal and thirst for knowledge enhancement. We reached to maximum capacity of our registration within 24 hours of opening the window. So for those who could not attend due to limited seats, we will upload the video on YouTube within a couple of days. I would like to greet the speaker as today's session is being attended by proper audience mix like low practitioners, seniors in corporates, and low learners, and not only from India but also from international universities. I would request this august audience to take maximum benefit by patient hearing and getting engaged in discussion when floor is open for the Q&A. We want to make today's discussion more fruitful by having interactive session. So for this, speaker will take pause at appropriate interval for attending questions from participants wherever possible. So participants are requested to text their question in the chat window. If they want to add to their question by audio, they can press the button for raise hand and we will unmute at suitable time. So I hope that the knowledge you acquire in this webinar proves profitable to your endeavors. So with this, I would now hand over to Mr. Yash Shah for introducing today's speakers for the benefit of large audience.
Thank you so much, Chintan bhai. Good afternoon, one and all. Hope in this mid-crisis of COVID, you are safe at home and following the proper guidelines given by government. So it's a privilege to introduce Mr. Dhaval Trivedi ji, who is a fellow chartered accountant and holding a position and as a director with tax and regulatory practice of KC Mehta and Company at Ahmedabad office. Prior to joining KCM, he worked with PwC Ahmedabad for about 9 years, including short-term stints at PwC Mumbai and PwC Taiwan. He is also a member of Institute of Company Secretaries of India and holds a certificate in international tax course conducted by ICEI. Also, he has been nominated as a member in International Taxation Committee of WIRC. He has more than 11 years of experience in inbound investment assignments, international taxation issues, PE issues, DTAA issues, FEMA issues, merger and acquisitions. Also, the list goes on and on. So I would just take a few contributions made by him in this international taxation field. He is a regular faculty at course conducted by ICI Diploma in International Taxation. He is delivering various lectures at Sardar Patel University. Sessions has been conducted at HLIC based college in Ahmedabad. He is also faculty for GMCS at Ahmedabad branch of ICI. Also, some of the major contributions as article on revolution of taxscape in India in BKR International's worldwide bulletin. Also, he has assisted in article on India tax and legal update for publication in Swiss India Chamber of Commerce bulletin. Also, he has assisted in contributing article on Article 10 dividends for publication in Chamber of Tax Consultants CTC. Also, there are various other publications on which he has published articles on. So now, not taking much of the time making introducing because he is a very eminent speaker, we need to hear for as much as time possible. So I'll now directly hand over the session to Dhaval bhai. Dhaval bhai, please. Thank you.
Thank you very much, Yash. First of all, I would like to thank you, Pratik, Chintan, and the whole team who has been organizing this kind of seminars. I think it is a tremendous feat, especially when everybody here is now looking at webinars every day, 3 webinars a day. I think in these times, it is very useful for fellow chartered accountants, members from the law field, and many others for whom you have been working day and night. I think, as Chintan mentioned, the participation reached 100 within the first day. That itself shows the enthusiasm that you guys have and the enthusiasm that the participants have, more importantly.
Sir,
I think,
just want to add one thing. We had to increase the limit from 100 to 120, 130, just for the sake of very senior members joining in. So we had a very restricted the numbers due to we want to make it more discussion based and debate based. Thank you, sir. Sorry for the interruption.
sure, Yash. I think I completely understand and take your point. So again, that adds to it. So, it's always a pressure to be speaking via net or through a webinar. More importantly, when it's a Sunday afternoon, and when you have all the registrations done in the first day. So what we are going to discuss today, as the topic suggests, it's the new dividend tax regime. I'm sure most of you have gone through the Finance Act 2020. You would have read a lot of publications around Finance Act 2020 and the dividend tax regime that has been brought in. And therefore, it becomes very critical to understand not only the prima facie understanding of the law, but also it is equally important to understand and interpret the law the way it has been drafted and the context and the intent with which the law has been drafted. This is the idea behind this course. So before even I plunge into the deep ocean, I would like to just clarify a few things that we are not in a haste. Let us take it slowly and gradually. The idea is to try and go through the amendments that have come in, try and understand them, look at various types of interpretations that are possible for each of these amendments, and then try to digest it and then try to apply our mind as to what should be the final conclusion towards a particular amendment. Trust me, while the topic is new dividend tax regime, it is ironical that this is actually the traditional dividend tax regime and not the new dividend tax regime. But for most of us, I'm sure there are senior members attending this webinar, and they would be more than helpful to us in terms of understanding how things were prior to the DDT regime. But yes, as I said, prior to the DDT regime, we had this classical taxation system on dividends. And therefore, I would say that it is not a completely new tax regime on dividends. So that is the first thing that we need to understand. India already has a history of this kind of a dividend tax regime. And hence, we could be opportune enough to get some precedents, some case laws, some commentaries on this topic. However, there are some amendments which are very new, which were not present in the erstwhile classical dividend taxation regime. And hence, we need to be extra cautious when we are interpreting it or giving an opinion or an advice to anybody. So with this background, I would like to again repeat that the idea today is to try and understand what the regime is, try and understand the various interpretations. So I was just trying to broadly capture, and to my surprise, there are around 50 questions coming up in terms of how could things be interpreted, broadly speaking. And hence, it is very important to try and understand what the dividend tax regime talks about. So what are going to be the contents for today's session? I understand that the session has been kept for 2 hours. So when I first heard that the session is for 2 hours, I was like, how can we finish things off, which can ideally take a full day, or it could be completed within an hour also. And so what we have tried to do is, I'm also thankful to Yash, Pratik and team who have broadly given me the subtopics for today's session. So in terms of contents, what are we going to cover today? We'll first brush up the amendments that will come in the Finance Act 2020 as regards dividends. Then we slowly and gradually start moving into the mechanics of it, starting with what triggers the taxation on dividends. That is something which is very basic and something which all of us should be very much aware of. As I said, this is a process. Please do not take it as a session to conclude on things. This is a process. It is an ocean. We are going to deep dive into the ocean during this session. And hence, we need to understand and just at least open our minds and invoke our thoughts as to, yes, this could be a possibility, or yes, this could be another way of looking at it. And therefore, it is very important to understand what is the basic premise of taxing dividends. So that would be the second point. Then we move on to how can one differentiate the type of income or the nature of income depending on the nature of investment. Once we are done with that, then we move towards deductibility of expenditure for dividend income. Then we look at ATM 115 PPD, and towards the end there was a specific request that we could broadly touch upon taxation of dividends in the hands of non-residents and withholding tax implications for the Indian payers, especially considering the MLI impact. So broadly, this is the content. We'll try to cover up each of these topics in great detail. Of course, while I understand that many of you would have many questions, but what I have done is I've also tried to put forth a lot of questions. So effectively, this session is going to be full of questions with multiple and varied interpretations possible to each of these questions. So again, the bottom line is, let's not try to find a conclusion. Let's try to find out an idea, or let's try to generate a discussion on the topics that are enumerated here. With this, I would like to move to the first portion of our presentation. The first portion is major amendments. So if I have to tell you broadly, even if you do not look at the slide, there is only one amendment that has come in broadly when you are talking about dividends. The dividends that were hitherto being taxed in the hands of the company under the garb of dividend distribution tax will now be taxed in the hands of the shareholders. So if I have to put the amendment in one basket, that is the broad level amendment that has come in by the Finance Act 2020. So yes, this one amendment could have multiple issues or sub points. And as I said earlier, there are around 50 questions that can come up. It's quite surprising in a country like ours, where the income tax law is changing every year. And with each change, there are multiple interpretations and multiple results that could be possible. And therefore, when we say that it is always good to have a consistent tax law in a country, this is a perfect example as to why countries should have a consistent and a smooth tax law for a continuous period of time. I'm not denying that dividend distribution tax has been there for almost 2 decades. But yes, when you are then bringing about a change in it and moving back to the original version, things could have been more simplified. So now if we look at the amendments, and the major amendment that I spoke about was shifting of the tax burden from the company to the shareholders. Broadly, my presentation is going to talk about taxation in the hands of corporate assessees. So the first and the foremost is the exemption under section 1034 is now no longer available, which was hitherto exempt in the hands of the shareholder. There was a section, there was no section that provided for a deduction because, of course, the income was not taxable in the hands of the shareholder. So as I said, these are all consequent changes under the broad amendment. So now they have brought in a section which provides for deduction in respect of dividend income. Again, if you look at the erstwhile classical taxation of dividends, this sort of a section was already present. The main section that we have grown up reading has been section 115O. And that's why when I say we have grown up reading this section, that emphasizes the fact that we need to unlearn a lot of things. If we try and speak on dividend taxation taking 115O as a base, we may falter. And therefore, there is a need to unlearn a lot of things when we are talking about section 115O. And it's time to learn afresh. And that is how we will be able to make proper interpretations about the topic. So section 115O will not be applicable from 1st of April 2020. Hitherto, it was being taxed as dividend distribution tax. Now that income has been made taxable in the hands of the shareholders, the corresponding question is, will the shareholder get a deduction for certain expenses? And of course, the Finance Act has brought in an amendment to section 57, which provides for deduction in respect of certain expenses that are incurred in order to earn dividend income. So broadly speaking, what the government has did is, the government has provided for a specific deduction in the nature of interest expenses, which however will be limited to a particular proportion of your dividend income during the year. So that is the broad amendment that is coming. So on the one hand, they are taking away the exemption. On the other hand, they are providing you with a deduction. As regards the non-resident taxpayers, 115 capital A already had a clause which provided for taxing dividends. But because of 115O being prevalent, they had a specific exclusion under 115A. Now that exclusion is removed, what does that mean? That means that dividend income to the foreign shareholders would henceforth be taxable under Section 115 capital A. Consequent changes to the withholding tax rates, as all of you know, when you are paying an income to a foreign party or a non-resident, you need to withhold tax at the rates which are specified in the first schedule part 2. Unfortunately or unfortunately, what has happened is when the budget came in and the finance bill was placed, there was no mention of withholding tax rate for dividends. But fortunately, after that, when the Finance Act came in, they brought out a withholding tax rate for such dividends which are paid outside India. ATM, again, as I said, it is a deduction in order to remove the cascading effects. So now if I have to relate, now that we have known the amendments, if I have to relate with 115 capital O, Section ATM also provides for a cascading effect removal provision. But as you would remember, Section 115O provided for removal of cascading effects subject to certain conditions, one of them being dividend received in the same year. In Section ATM, of course, there are certain conditions which we'll look at, and we'll also look at multiple interpretations that are possible around deduction under Section ATM. So broadly speaking, these are the major amendments that have come in as regards taxability of dividend income. With this, we'll now move on to the first main topic which we need to discuss. What triggers taxation on dividends? The broad understanding that we carry is that there is a phrase which talks about declaration, distribution, and payment. So because, as I said, again, we need to unlearn a lot of things. Section 115 capital O talked about this phrase, dividend declared, distributed, or paid. And hence, at times, because of the subconscious thought process that we have, we may tend to believe that all the three could ultimately mean the same. So broadly speaking, when we are talking about dividends, commercially, how does it flow? So what are the events? So the events could be that first the board will pass a resolution. They will kind of recommend dividend. If it is a final dividend, then there could be annual general meeting wherein the dividend will be declared. There could be a payment to the shareholders once the dividend is declared. And yes, once there is a payment, effectively it means that the shareholder had received the dividend. So that is the broad structure, broad event. Now, if we look at what are the events that the income tax law has captured, let's learn afresh. What are the events that the income tax law has factored in terms of taxing of dividends? So on this particular slide, what I've tried to do is I've tried to capture various sections. I've not captured all, but the most relevant ones. So if you look at the first basket, which is declaration, distribution, and payment. So these three terms are used in various sections. Section 8 has to be the predominant section that one has to read through. So whenever you now relearn, Section 8 is going to be very relevant. It talks about all the three, declaration, distribution, and payment. The section on dividend distribution tax, which is 115 capital O, also talks about the three elements, declaration, distribution, and payment. Same is the case with 115 BBD, which talks about taxation of dividends from specified foreign companies. And yes, there was one section which was applicable for a very short period of time, which taxed dividends in excess of 10 lakh. Even that section talks about the three elements, declaration, distribution, and payment. Very interestingly, just a moment. Very interestingly, none of these sections directly refer to receipt of dividends as a taxing event. And hence, we need to understand why. On the right hand side, I've kept receipt as a separate event. So the first question that should ideally come is payment different from receipt? So that should be the first question. The second question could be, is declaration different from payment, or is it the same? So broadly speaking, now when I look at declaration, distribution, and payment, for the past 20 years, because there was this dividend distribution tax, we have only heard of this. However, now when you look at Section 8, which is the primary section around taxing of dividends, you will read that Section 8 in itself provides for taxing events. So for example, if I have to read Section 8, it says for the purpose of inclusion in total income of an assessee, any dividend declared by a company or distributed or paid by it. So here they talk about declaration, distribution, and payment. Is there a difference? There is one. I will read the language again. It says any dividend declared by a company or distributed or paid by it. So they have again bifurcated into two baskets. Any dividend declared by a company is the first basket, or distributed or paid by it. They have not used the term any dividend declared, distributed, or paid by a company. They have said any dividend declared by a company or distributed or paid by it. So they are trying to create two separate baskets within the primary section, section 8. What is the reason behind it? And again, one point which I missed in the beginning is we will not focus on case laws much. We'll come to case laws towards the end of the session, because many a times we get carried away by judgments and judicial precedents. So I would just request if we can first look at the principles and then look at the judgments, so as to get a perspective as to how judiciary views a particular provision. So now coming back to this, section 8 provides for the first three items. Now when we talk about receipt, why is section 8 not talking about receipt? Why does it only talk about these elements which are from the side of the distributor or the payer? Principally, once, and we'll come to that on the second slide, so maybe I'll park that for a moment. When you are talking about receipt, which is on the right hand side, receipt, the reference of receipt of dividend surprisingly comes only in three sections broadly. One is section 1034, and that too now after the amendment, and we'll discuss about that. There is a proviso which has been inserted in 1034 which makes a reference to receipt of dividend. Section 80M and section 115O, both the sections, when they talk about removal of cascading effect, not the main provision, but when they talk about removal of cascading effect, in that context they are referring to receipt of dividend. When is payment relevant? So payment is broadly relevant in two circumstances. It could be more, and you can also use it generally, as in once the company declares a dividend and then it pays it. That is a general understanding. But specifically, there are two provisions. One is section 222E, wherein you talk about deemed dividend. In that case, the language that has been used is any amount paid. When you look at 222A to 222D, the language that is used is distribution. And section 80M also talks about distribution. So we will come to this when we look at section 80M. In the context of international tax, and we are talking about cross-border transactions, very interesting. Article 10 of a treaty generally would refer to dividends. That article does not talk about dividends received by a company or a party of a contracting state. DTAAs generally say dividends paid by a company which is a resident of a contracting state. And therefore, payment becomes relevant when we are looking at a DTAA situation. So broadly speaking, there are multiple events, multiple nomenclatures used in different provisions, which could have a different interpretation and a different meaning, resulting into the tax liability. Just to summarize, section 8, again I go to section 8, it says any amount declared by a company. So that is what section 8 says. So now coming to the issues surrounding this. So when you are looking at a final dividend as per the Companies Act, so is there a difference between taxing a final dividend and taxing an interim dividend? So broadly, when you are talking about a final dividend, it is declared in the annual general meeting. In case of an interim dividend, it is on the powers of the board to declare interim dividend. So that is the primary difference when you're talking about a final dividend and an interim dividend. Is it the point when the dividend becomes a liability that it becomes taxable? So do you have to see it from the payer's perspective continuously, even in the new regime? Now that the company does not have to pay tax, but if the recipient has to pay tax, do you still continue to look at the liability on the company's side in order to determine whether dividend is taxable or not? So if one was to say that yes, the trigger point is the liability for the company, then what event should you consider as the event triggering the liability? Will it be the board approval? Can it be declaration in the general meeting? Or only when you ultimately pay it as a company, it becomes your liability? So that is a point that one needs to consider. A corresponding question is, and we'll discuss the whole thing, but the corresponding question is, can one say that once I make available the dividend to the shareholder, as in from my side, if I've released the funds or I have made necessary arrangements to release the funds, can I say that the shareholder becomes taxable in respect of that dividend, or he has that right which makes him taxable in respect of that dividend? So the first three major bullets have to be read together, and therefore now if you look at it, the principle is read with section 8. The principle is, when you are looking at a dividend which is declared in an annual general meeting, the moment the dividend gets declared in the annual general meeting, that triggers the tax liability in the hands of the shareholder. When you're talking about interim dividend, however, and the reason why it becomes a liability is, under the Companies Act, once the shareholders declare dividend, it becomes a liability in the hands of the company, and the shareholders can force the company to pay the dividend. There are judgments which will refer to towards the end, but somewhere in consonance with this basic principle. When we are talking about interim dividend, in interim dividend, it is the directors who effectively recommend dividends, and they have all the right to resign that dividend or cancel it. And that is the major reason why, when you look at interim dividend, the interim dividend becomes taxable only when it is unconditionally made available to the shareholder as per section 8. So that is very important. Again, what do you call unconditionally made available? There are judicial precedents, we will discuss them later, but broadly speaking, once the shareholders has a full right on that dividend, so if there is no contingency attached to it, once the shareholder, the company either puts into your account, so broadly, when I say unconditionally made available to the shareholder, one may broadly say that once the amount is paid and received by the shareholder, it could become taxable. So in that sense, when you are looking at interim dividend, payment and receipt could work simultaneously or go in tandem. Another interesting aspect is, now that the dividend is taxable in the hands of the shareholder as per the normal provisions, what happens to 222E? 222E refers to two situations, as you all know. The first situation is when the shareholder gets a loan, and second is when a third party gets funds. So in that case, who should be taxed? Should one continue to tax the shareholder even if the third party has got the funds? This is a big question mark. There are differing judgments available. However, an interesting observation was, if you recollect, when you're talking about dividend distribution tax, I think in 2011, the finance minister made an amendment. Earlier, 222E was not covered in dividend distribution tax. Later on, in sometime in 2011 or 12, this 222E dividend was also brought to tax under dividend distribution tax. At that point in time, the memorandum says that till date, this kind of a dividend was being taxed in the hands of the recipient. Principally and logically, if you think, it should be the shareholder who should be taxed. However, this passing reference or this intent which has been mentioned in the memorandum explaining the finance bill provisions of 2011 or 2012 could create a dicey situation whereby one can say that the recipient was supposed to be taxed and not the shareholder. But logically speaking, ideally it should be the shareholder who should be taxed in respect of these transactions. A small point that I've mentioned on the right hand side is the ICDS impact. All this we have already discussed. Is there any different perspective in ICDS? So ICDS, fortunately, on revenue recognition makes a reference to the income tax law. So the ICDS does not provide for a separate taxing mechanism for dividends. It directly refers you to the Income Tax Act. But just for the sake of completeness, I thought I'll just bring out that perspective, that eventually what you need to look at is the Income Tax Act when you're looking at taxing dividends. So broadly speaking, declaration is going to be a very important point. However, as I said, there are three sections which talk about receipt of dividend. So then how does that interplay? Does the understanding that we had in the earlier slide, that declaration is an important trigger, does it get diluted if we look at the sections which provide for receipt of dividends? So here what I would like to bring to your notice is section 1034. Section 1034 has been, it was a section that provided for exemption in respect of dividends referred to in 115 capital O. So here I would like to go a bit slow, so that we try to interpret properly. So what has happened is the main provision of section 1034 read as any income by way of dividends referred to in section 115O. So the reference in the main section was for dividends that are declared, distributed, or paid by a domestic company. So that was the reference in the main provision. What happened was, in the finance bill, so it was very clear that if the dividends are such which are paid or distributed or declared by a domestic company, such dividends would be exempt in the hands of the shareholders. Now with the change in the law, what has happened is there is a proviso which has been inserted, and the proviso as first inserted read like this: provided further that nothing contained in this clause shall apply to any income by way of dividends received on or after first day of April 2020. So here the language that is used is income by way of dividends received on or after first day of April 2020. Does it create a different perspective now in terms of taxability of dividends? Because if you read the language otherwise, it says that any income by way of dividends received on or after 1st April 2020 shall become taxable in the hands of the shareholder. So receipt in that sense could make a difference, one may say. There could be another view. The another view is that the receipt of dividend, they are referring to the income inflow of dividends, and hence the word received is used in that context, and one has to read the words contextually. In that sense, the usage of the term received would not make much of a difference, and still one may say that once the DDT has been paid under 115O, such dividends will continue to be exempt. But if after 1st of April 2020 DDT is abolished and any such dividend income in the hands of the shareholder becomes taxable, to my mind the second view is more logical. One has to read it contextually, and that was the view that was prevalent. But there was a segment of the industry which made a representation, and they said that if you provide for such a proviso, there are bound to be double tax situations. First, when the company declares the dividend, it will pay DDT. Second, when the shareholder receives such dividend, the shareholder will again be taxed. This was based on the first view, which is the literal reading of the proviso. We believe that the term received was used contextually, but there were representations made. Unfortunately, the government came up with a clarity also for those representations. The government, and now I move to the right hand side of the slide. The government came up with an amendment and said that provided further the same language, and then they specified other than the dividend on which tax under section 115O and section 115 BBDA has been paid. Now, because of what we understood in the earlier slides when we talked about section 8, the taxing event was declaration, barring for interim dividend. I may park it for a moment, but broadly speaking, it was either declaration, distribution, or payment, or whatever terminology that was used. The contextual meaning would have sufficed. It would have been sufficient in order to give it a correct meaning. But in order to give more clarity, the government has come up with this additional phrase, which could create an issue in terms of the interpretation. Because now what they are saying is that yes, your representation was correct. There could have been double taxation, and hence it is better to clarify that other than the dividends on which tax under 115O has been paid. Here one may try to argue that, and hence income by way of dividends is taxed in the hands of the shareholder only on receipt, and not once the dividend is declared. So here there is I would say there is a different thought process between section 8 and section 1034 and the proviso which has been inserted. And that is why I have put forth the question that I have put forth. And the first is very clear, what I already told you, that does the change alter the contextual meaning of receipt? and thereby the trigger point also changes, which is what one can now take a view based on the amendment in the Finance Act. The second point is main proviso vis-a-vis the proviso, main provision vis-a-vis the proviso. As I said, the main provision already referred. So the proviso has to be read with the main provision. The main provision talked about dividends, which are referred to in section 115 capital O, which eventually led to a dividend distribution tax liability. Now, if I read the proviso in that context, then one can never infer that you are actually talking about an actual receipt. However, because of this amendment, there will remain this inconsistency, which will have to be settled at some point in time. So this was the second point that I wanted to bring to your notice in terms of trigger to taxation. So broadly, what we discussed was there could be different trigger points, possibility of a misinterpretation of or a different interpretation, I would put it that way. As in, why was there a need to use the word received, while actually dividends are taxable when they are either declared or distributed or paid. So that was the first issue that we wanted to discuss, which had multiple questions, as I told you earlier. Now moving to the second section of the presentation. This again is a very interesting topic, and I'm sure a lot of practitioners would love to discuss on this particular section. So what we are now discussing is, what is the nature of this income? Now that a shareholder is taxable, what would be the head of income under which you will tax the dividends? Or if not the head, does the source of income make a difference? That is the first question. And hence, what I've tried to, I've kept only one slide on this particular topic, but we'll try and cover the discussion as much as possible. Broadly, what kind of investments do we generally make? So if I am a trader, I would have these investments trading in securities, then these investments would be a part of my stock in trade. There is this phrase which is now after 14A litigation, and all of us have seen a lot of litigation around section 14A, and hence there is this new phrase that we all are very much aware of, which is called strategic investments. It all started with an argument saying that if I'm making an investment for adding to my own business, if I'm making an investment in any company which eventually will benefit me, can I take an argument that is not a normal investment, it is a strategic investment, and 14A should not apply? That is how it all started. So I've even tried to keep that in the basket. And the third is somebody who is just investing in shares and securities to earn passive income out of it, or just to earn rewards out of the investments that one makes. So broadly, these are the nature of investments that one would make, and therefore it becomes important that does the change in nature of investments trigger a change in the nature of income? I've not put a question mark in the first point, PGBP, but effectively there is a question mark is what you should read it like. So the question is, when I am a dealer in stock in trade, does my income be considered as profits and gains from business or profession? So does my dividend income become my business income, or is it getting taxed under PGBP? Same is the question for strategic investment, whether it should, because there is a higher degree of doubt when you talk about strategic investments. I've tried to cover both PGBP and income from other sources. When we are talking about passive investments, of course, generally, so the question, I think the question mark has got swapped. It was supposed to be on the first box and not the last one. So when you're talking about passive investments, the income would ideally fall under income from other sources. This brings us to an interesting subtopic, which says, do I always tax a particular income under a particular head of income? Or do I offer a particular source of income always in a particular head of income? So for example, if I'm a trader in shares and securities, so effectively it is a business that I'm carrying on, business in securities. Can one say that therefore the income should be taxed under the head profits and gains from business or profession? Very much possible, very much possible. highly likely. There is a differing view which we'll discuss. When we are talking about strategic investments, again the same question. So now let's look at the scheme of the act. The scheme of the act breaks down various incomes under different heads, and two such heads are profits and gains of business or profession and income from other sources. With this background, now if we look at dividend income, section 56. So just give me a moment. I'll just read through the bare language, and that is very important, and hence I'm trying to read through the language. So there is this first subsection which says that income which is not to be excluded from the total income shall be charged to income under the head income from other sources if it is not chargeable to tax under any other heads, items A to E. Then there is a subsection 2 which is very important in our discussion. Subsection 2 of section 56 says, in particular. So now there is a specific reference. Subsection 1 was a generic provision. Subsection 2 is a very specific section. It says in particular, and without prejudice to the generality of the provisions of subsection 1, the following incomes shall be chargeable to income tax under the head income from other sources. So they are saying that in particular, income of the following nature will always be taxed in this particular head, which is income from other sources. The first item is dividends. So what does this reading say? This reading says that once you have an income which is in the nature of dividends, it should ideally be taxed as income from other sources. Forget your nature of business. That is the first view. The second view is, in the first type of investments, it is always my business income. I can surely put it under profits and gains from business or profession. A possible view, as I said earlier. Can one argue that the reference in subsection 2 on dividends is only to give an example, specific example, but it does not bind you that even if your nature is business, you still have to offer it to tax under income from other sources? That brings us to the other interpretation. Now, if I read the other clauses in subsection 2, we have talked about dividends. It plainly says dividends. Then there are some other income elements. For example, income by way of interest on securities if the income is not chargeable to tax under the heads PGBP. Income from machinery, plant or furniture belonging to the assessee and let on hire if the income is not chargeable to tax under the head PGBP. So the first subsection had a specific reference, I had a general reference. Subsection 2, clause 1, talking about dividends, plainly talked about dividends. The other subclauses, very important, the other subclauses are making a specific exclusion. They are saying, for example, interest. So interest will be specifically taxed under income from other sources if it was not taxable under profits and gains from business or profession. So there is a difference between the two. When you look at dividends, it's a plain word dividends. It does not come with a caveat that dividends other than dividends chargeable to income tax under the head profits and gains of business or profession. That makes the first view stronger, possibly stronger, saying that irrespective of the nature of investments, your income which is in the nature of dividend should always go as income from other sources. We'll come to judicial precedents. I'm sure there are differing views amongst the audience also. Of course, there are judgments which have a differing view. But what I wanted to, again, as I said, it's more about the principles and getting a clarity on possible interpretations, so that whenever we analyze a particular situation tomorrow, we at least know that, yes, there is a different perspective which is possible. If we go by this reading of the section, one may say that irrespective of the nature of investments, income which is in the form of dividends will always be taxed under the head income from other sources. Why I'm stressing on this is this will have a big impact when we are looking at the subsequent slides, and therefore this becomes quite important. Having spoken about the head of income, now is there somebody who has unmuted himself? Okay.
You can proceed. There were some issues.
Okay, fine. So now that, just a second. So now we are talking about a situation, now that we have already spoken about heads of income. Is there a different thought process when we are looking at a source of income? And that is also very relevant, and hence I am trying to differentiate both of them. A source of income could be a part and parcel of a head of income. Now let me give you an example. The dividend income, if I'm a trader in securities, the dividend income that I generate is a source from the business that I have. So the source of income is business income. So can I say that my source of income is business income? However, because of the specific requirement of the act, it will be taxed under the head income from other sources. There is a possibility on this, and it could have its own implications when we are looking at deductibility of expenditure, and when we are looking at deduction under chapter 6A, and later on when we are looking at 115 BPD. So principally, just try and understand, there are two views. One may say that even the head of income is profits and gains of business or profession when you're looking at stock in trade. Coming to strategic investments for a minute, before we conclude on this slide. The principal argument that taxpayers have been making is that when I'm making an investment in a subsidiary, either in India or overseas, the idea is to try and get benefit out of it. And I think that is the thought process that all corporates would be having in terms of making investments and getting a benefit out of it. Is it possible to continue taking that argument is the first question that I had. So when we are looking at strategic investments, see, if one has to go by that logic, then there will be a very thin line of difference remaining whenever a company makes an investment into a subsidiary. There is a judgment on this, and we'll refer to it, but I'm just trying to say that an argument of having a strategic investment and thereby taxing it under PGBP could become a substantially diluted argument if one was to take, because in that case, almost all cases wherein there is a investment in a subsidiary could be prone to this litigation, whether it would be under PGBP and income from other sources. So how does we already read section 56(2), so that was the point that I had mentioned. And yes, there are judicial precedents around this, which we'll surely discuss later on. So again, concluding on this slide, head of income, source of income, nature of investment, could it have a different impact in terms of the taxability of heads of income? Multiple interpretations possible, but as I said, reading of section 56 could make you tilt towards a particular position in terms of the head of income under which the income is being taxed. By keeping aside the nature of business, the source of income. The source of income doesn't deviate with the head of income. That is very important. The source of income continues to remain what it is and does not change its character merely because there is a head of income. The logic which I try to understand, where if we have to understand what would be the thought process behind this. So generally, when you are making investments, the first prerogative is to generate income by selling those investments. If you are a trader, and generating revenue out of it. Any dividend income that you gain out of it would largely, I would not say in all cases, largely be a passive income. And therefore, irrespective of the nature of investment, dividend income could be taxed under income from other sources. That is how the law has been drafted, is what I sense from the current drafting of the law. Having considered section 56 and taxability between business income and other sources, now let's move to the other interesting aspect of deductibility of expenditure. So now this is more of a text that I have brought in on the slide, but it was important to bring this text while I speak about it, and I will try to narrate the whole amendment. But it would be good if we can also read through the slide as we discuss. So what was the situation pre-amendment? Pre-amendment, there was a clause in section 57, clause 1. Clause 1 of section 57 said, and as you all know, section 57 talks about deductions when you're computing your income from other sources. So what is a deductible expenditure? So in case of, this is the language, in case of dividends other than dividends referred to in section 115(o). So as you know, we are talking about the pre-amendment scenario. So when dividends were not taxable, and hence they had brought this phrase other than dividends referred to in section 1150. So it said, in case of dividends other than dividends referred to in section 1150, any reasonable sum paid by way of commission or remuneration to a banker or any other person for the purpose of realizing such dividend on behalf of the assessee. So here there is a specific clause attributable to dividend income, which says, and the logic behind this is, generally when you look at dividend income, in order to generate that income or in order to get that income, you don't necessarily spend anything except for some amounts that you may pay to either your commission agent or to your banker in order to realize the dividends. And therefore there is a specific clause in section 57. Here I would now talk briefly about a principle called principle of sui generis. What does this principle say? The principle says that by its own, the meaning is on its own. So there are commentaries in the context of the erstwhile classical system of taxation which referred to interest and dividends both, and it is important, it referred to interest and dividends both, based on which there were Supreme Court judgments which said that when you are talking about interest and dividend, these are incomes which are sui generis and you don't incur any expenditure for such types of income. This principle had a very important role to play in section 14A. People started misreading the judgments and trying to argue that there is no expenditure that I incur for earning that dividend, and hence there should not be a disallowance in 14A. But this principle, if you look at the principle, it is a valid principle. The judgment that have used this principle have just made a reference to it, saying that generally there is no expenditure, but of course if you are going to borrow money to invest, you are going to incur interest expenses. That brings us to the second bullet, which says any other expenditure not being in the nature of capital expenditure laid out or expended wholly and exclusively for the purpose of making or earning any income. So again, a very broad, wide statement, but it could create a lot of difficulties and chaos. This clause 3 says, so the first clause 1 was very specific to dividends. The third clause said that any other expenditure that you would have laid out or expended wholly and exclusively for the purpose of making or earning such income would be a tax deductible expenditure in respect of that income. As I said, there was a 14A impact, and a lot of you, most of you would be aware that in the litigation that has happened around 14A, majority of the litigation has happened around the borrowed funds, whether interest on borrowed funds, whether they are relatable to exempt income or whether they are not relatable to the exempt income. And hence it is important to know that section 14, and I think it's quite settled that to an extent it is settled that interest on borrowed funds, to the extent it is specific to that investment, could attract 14A. General borrowings, there is a lot of judicial precedence around it. We will not discuss that for the time being. Now coming to the amendment, what has happened? The amendment, there is one amendment which has happened to section 57 clause 1. It's a very simple amendment. Just in order to remove that DDT portion, they have removed the reference to that phrase other than dividends referred to in section 1150. So now the way the clause would read is, in case of dividends, any reasonable sum paid by way of commission or remuneration. This is in section 57 clause 1. That is the first amendment, a very simple amendment. Just removing the reference to 1150. The second and the more dangerous, I would put it this way, the dangerous amendment is in the new proviso that has come in. What does the proviso say? The proviso says that provided that no deduction shall be allowed from the dividend income other than deduction on account of interest expense, and in any previous year, such deduction shall not exceed 20% of the dividend income included in the total income. So what has happened is, broadly, if I talk about this amendment broadly, what has been said is, whenever you have a dividend income, the maximum deduction that you can claim, is 20% of your dividends. The nature of such expenditure has to be interest income only. This is the proviso. it could have glaring implications. First, the first question is, and as I have mentioned in the bottom of the slide, is there a possible mischief? If I look at it that way, there is a main provision. As I said earlier, there could be a proviso to it. Now, this proviso, just for your understanding, this proviso has not been brought under a particular clause. This proviso has been brought in under section 57 generally. So it's a general proviso for the whole of section 57. So it encapsulates both clause 1, clause 2, clause 3, and there are other clauses that are there. So the first question is, and very interestingly, I do not get a deduction of a specific expenditure. I understand that the quantum would be very low and not substantial enough if I'm looking at clause 1. But if you are drafting a law, or if there is an amendment that is coming in, one has to factor that there is a specific clause 1, which is there in the law. Now that you have brought a proviso in the law, you are allowing a deduction only in respect of interest expenses. So effectively, you are nullifying the main provision. So I understand that a main provision can be nullified by a proviso. For example, 1034, the main provision has now been nullified by saying that it will not be exempt. But when you're looking at this kind of a situation, when you're talking about allowing a particular expenditure, you are saying that you will not get a specific deduction, but for interest. Now here also, they are saying that other than deduction on account of interest expenses. So they have tried to restrict the deduction. The question is, the ongoing 14A litigation matters. Now I think let's move to the questions on this. What happens to the general borrowing? So the way the law is drafted now, I don't see a challenge that you cannot take recourse to general borrowings, because it only says interest. So far as one is able to demonstrate that the interest is directly relatable and wholly and exclusively incurred for the purpose of making an investment, even that interest should get factored is the broad idea. So I don't see a major challenge in that interpretation. Now, when we are talking about 14A, before I move on to the second bullet, if I'm the tax officer, can one say that if the taxpayer is trying to argue that no major interest has been incurred, or I also understand that a lot of taxpayers were trying to demonstrate a scientific basis. So what happens because of this amendment? And that is what I'm just trying to think like a tax officer. First is those specific expenses or management expenses for managing the investments would clearly go out. The only thing and the disallowance that I would like to make, if I'm the tax officer, I would make a straight away disallowance of say 20% of the dividend income. Just a wild thought. I'm just trying to draw a corollary as to if it could have an implication on the ongoing 14A issues. So that is a thought. And of course, even for the taxpayer in the current ongoing 14A matters, can this amendment prove to be relevant? I understand that these are completely different provisions. One is on 14A relating to exemption. This is now an amendment. It is a prospective amendment. But in terms of relatability, ultimately what you are talking is a dividend income and your expenditure relatable to dividend income. So that is another aspect that I wanted to bring to your notice. I see a very strong chance in terms of people making a reference to this new amended provisions, either the taxpayer or the tax officer, both ways. I see a very strong possibility in that case. Now coming to the other very interesting aspect, and this is something that we generally miss. The phrase that is used in the proviso, the phrase is, I'll again move back to the earlier slide. Look at the last portion of the proviso. The last portion of the proviso says, included in the total income for that year without deduction under this section. So when they are talking about the quantum of deduction eligible under 57, they are saying 20% of dividends. So the normal understanding, and even if you look at the memorandum, the normal understanding was dividend ke 20% expenditure. However, the way the section has been drafted, the proviso has been drafted, it says dividend that is included in the total income for that year without deduction under this section. Now, that brings me to that question. What do you mean when you say included in the total income before allowing deduction under this section? So if I had to do a literal reading of this proviso, a literal reading would tell me that first, so it ultimately will boil down to a circular reference. How? So you say that first I need to identify what is the amount of dividend that is included in my total income. For that, I need to compute the total income. However, once I compute the total income, I add back the deduction that I would have ideally claimed. And then 20% of such dividends is what I should be claiming under Section 57. Now, as you all know, there is a difference between total income and gross total income. Whether this will make a difference, because you have a lot of deductions also under Chapter 6A, there would be losses, other expenses. So effectively, what is the necessity of this phrase? I cannot straight away say that it is irrelevant or it may not have a relevance, because if that be the case, this phrase was not required. And to my logic and my understanding, this phrase was otherwise also not required. You could have easily said dividends, taxable dividends or whatever, but you could have avoided the phrase total income, or maybe a usage of gross total income could have diluted that risk or that potential misinterpretation. Unfortunately, that is how the law stands as of now. The other view, now coming to the other view, the first view was based on a literal reading of the provision. If you look at the logical understanding, when you are using that reference, that dividend income included in total income, so they're talking about it philosophically, that if your income during the year, if your overall income, the definition of total income again has to be read contextually. That is very important, of a principle for interpretation. Every definition has to be read contextually. The first view that we took was on a plain reading of the definition of the term total income. If we had to do a contextual reading of the term total income, if you read the literal meaning of the term total income, this is creating a nuisance. But if you say that here the total income is the philosophical total income, as in the total income of that person of that particular year, irrespective of the tax mechanism or the scheme of the act, then one may say that the reference is only to gross dividends and the total amount of dividends, and hence the 20% limit should apply to gross dividends. So that is the other interpretation which is coming out, which seems to be more logical. However, because of the specific phrase which has been used in this particular proviso, I'm afraid that there will be a scope for misinterpretation, and there could be some calculation issues that may come up at a later stage. The other point that I have mentioned here is what is the impact on 115 BBD interpretation. Here, I would just want you guys to keep this particular phrase in mind, because a similar phrase is also used in 115 BBD, and therefore I thought I'll bring it out here also, that the two views that we discussed, the literal meaning and the contextual reading of the term total income and included in total income, will be equally relevant when we again move back to 115 BBD later on. So again, very important, 14A is what I already discussed. So we already discussed the basic tenets of taxing dividends. We talked about characterization of the income and the heads of income. Then we talked about deductibility of expenditure for such dividends. Now, so these are going to be highly technical, I'm sure, and I took that liberty because we have such a large audience on a Sunday afternoon. So I'm sure most of you are technically very agile and enthusiastic about the tax law. So I've tried to take more technical readings, and that is why it is called an ocean of interpretations, just to bring out all possible scenarios that I could see in the last 3-4 days. So now the couple of sections that we are going to deal with has been dealt with at large by a lot of speakers and in a lot of articles. So we'll try to once again read through these amendments, because these are important and could have a far-reaching impact. So what has happened is they have inserted section 80M, and I'm sure by now you got a chance to read through the section. Broadly speaking, the principle is whenever, as I said earlier, in order to remove the cascading effect, because when you receive a dividend, you are taxed, and when you again distribute it, the other person could be taxed. So in order to remove the cascading effect on such dividends and give them a pass-through, there is a section which provides for a deduction. Again, the language is quite similar. It says when the gross total income of a domestic company includes any income by way of dividends from any other domestic company or a foreign company, there shall be, in accordance with and subject to the provisions of this section, be allowed in computing the total income of such a domestic company a deduction of an amount equal to so much amount of the income by way of dividends received from such other domestic company or foreign company as does not exceed. So here is where they are bringing the cascading effect point. As does not exceed the amount of dividend distributed by it on or before the due date. So what they are effectively saying is that you will get a deduction of your dividend income. However, when you are quantifying that dividend income, you have to see what is the amount of dividend that you have distributed on or before the due date, and then you get a deduction under ATM. So that is broadly the principle. What does the second subsection say? It says where any deduction in respect of the amount of dividends distributed by the domestic company has been allowed under subsection 1 in any previous year, no deduction shall be allowed in respect of such amount in any other previous year. So here they are putting a restriction, and the restriction is once you have claimed a deduction for a particular amount, similar deduction in respect of the said amount will not be allowed. Important amendment here is that the due date is not the due date of filing tax return. So you know, this time when you read the Finance Act 2020, and hopefully we will get the hard copies soon once things improve. But the important change here is that a lot of sections have made a reference to due dates being 1 month prior to the due date of filing tax return. So first is we should not get confused that the due date is the due date of filing tax return. The due date is 1 month prior to the date of furnishing the tax return. So if the due date is 30th November, then the time limit for checking the distribution is 30th of October. So that is something that we need to keep in mind. Now, this is the principle that we discussed on the new section 80M. A lot of questions, and we also had an internal discussion on this. And you know, I would like to thank my team members also who brought up these questions. But I think this is very interesting. So as I said in my first slide, receipt of dividend has been used in very limited sections. One was 1034, the other one is this 80M. So now when we look at the first point, receipt of dividend, how is it relevant, whether it is a precondition? So here now, if you look at the section, in the first part of the first subsection, it only talks about includes any income by way of dividends from any other domestic company. So here the words used are any income by way of dividends from any other domestic company. Now come to the second part of that subsection. It says so much of the amount of income by way of dividends received from such other domestic company as does not exceed the amount of dividend distributed. So we need to see the purpose behind usage of this phrase. Can one say, and again this will again boil you down to the primary question, can one argue that dividends are taxed on receipt basis for the shareholder? So the question is, so if I go to the history of this section for your reference, even in the erstwhile tax law, the erstwhile classical system of taxation, there was this section that provided for a removal of cascading effect. The word used was received earlier in the first part also, and subsequently it was removed from the first part. So broadly, what I'm trying to tell you is that when you're talking about receipt of dividend, so should I be eligible for a deduction? So the primary question is, should I be eligible for a deduction only if I physically receive the dividend? Or, so as I said earlier, section 8 talks about declaration. So what would happen in a case where I tax my income on the basis of declaration by the distributing company? However, when I come to deduction, because I have not actually received the dividends, can somebody say that you are not eligible for ATM? That was the primary question. So I feel that seems to be a bit far-fetched in terms of the logic and the intent, because here when you look at the word received in the second part of subsection 1, it only talks about the incoming dividend, as in the income that you have. They want to differentiate it from the dividend distributed that we have used in the later part of the second part. So in order to differentiate that, they have used the words dividends received from such other domestic company. This understanding also coincides with the reading of section 8 that talks about taxability on declaration or distribution. So that is the first question that I wanted to bring to you. The second is timing of distribution of dividend. Again, this issue was also there during classical system. This issue was also there during dividend distribution tax, and I'm sure this issue will come up in the near future when we are implementing the new dividend tax regime. So what should be? Now here you get a deduction, and the comparison has to be with the amount that you have distributed on or before the due date. The amount that you have distributed on or before the due date. So in that case, if I'm talking about a cascading effect, so if we look at the intent earlier, the intent was if you have received a dividend and you are distributing that dividend, in that case you will get a deduction, or in that case there could be a cascading effect if it is the same transaction flow. Once you receive the dividend and then you pass it on, there could be a cascading effect. Can one say that the pattern of receipt and distribution is irrelevant, irrespective of whether you first distribute the dividend and thereafter earn an income? Once both the events happen in the same year, because there is a cascading effect broadly and on an overall perspective for the year, can one say that the cascading effect continues? To my mind, it should be possible to argue that irrespective of the flow of dividend income upside, once you have a dividend income and a dividend distribution within the same year, and now before the due date, as mentioned in the subsection, it should be possible to say that there is no requirement that the dividend should be in the same year. A differentiating point with 1150 here is when 1150, a lot of you would again recollect that in 115 capital O, there was a requirement of dividend being received in that particular year. So there was a requirement that in the same financial year you should receive the dividend, and hence in that context the term receipt was very relevant. Now here, when you're looking at it, here it's the other way around. It's like distributing and then generating income. So here the section does not provide that it has to be in the same financial year. What could this mean? It could mean that if you have distributed dividend and in a particular year your income is not great, you have distributed dividend out of past profits, then in that case you will have an excess dividend distributed which you have not utilized for claiming a deduction. Because now there is no specific requirement, one may possibly say that such amount of dividend distribution which was not utilized for claiming a dividend income can be offset in the future, can be carried forward. A very much possible argument to take. Currently the law does not prohibit it. There is no provision that talks about it. The only requirement is before 1 month prior to your date of filing of return of income, the amount should have been distributed. So if you are talking about the past year, the amount is already distributed. So it may be possible to try and claim a deduction based on that argument. What is the deduction? One question that comes up. See, when you read subsection 2 here, the question is, what is the nature of deduction? Is it a deduction in respect of income, or is it a deduction in respect of distribution? That could also have an impact when you are looking at the amounts. That is the subsequent question that we are going to talk about. So section 80M, as we read, is it a deduction based on distribution or a deduction based on your income? So as you know, the scheme of the act provides for chapter 6A, and chapter 6A has multiple parts. This part 80M falls under part C, which talks about deduction in respect of certain income, and therefore one may say that deduction under section 80M is in context of income and not in context of distribution. So for example, 80C and alike sections are more about the outflows. They talk about your expenditure, your investments. If it had to be a distribution, it could have been something on similar lines. But the way the section has been drafted and the placement of the section says that this deduction is in respect of income and not in respect of an expenditure or a distribution. So, however, if one has to argue, subsection 2 says where any deduction in respect of the amounts distributed. Let's read it again. It says where any deduction in respect of the amount of dividends distributed by the domestic company has been allowed. Can one say that while the placement is in part C, effectively what you are getting is a deduction of dividend distributed, and not a deduction of your income. Why would that be relevant? Is when we look at the next question. What should be the amount of deduction? Should it be your gross dividends or should it be your net dividends? Why is it relevant is, say for example, you have an income under section 56, you have some expenses under section 57. The way the language is used, it says, so if you read the first part, it says where the gross total income includes. So the view is that it is a component of your gross total income, and gross total income would ideally have your net income because it is a sum of all the heads. So ideally speaking, it would be the net income that will go into your gross total income. So one has to read the first line together with the second line, and hence a net income is what you should be entitled to in terms of the deduction. However, the issue will arise because of the second part, which says a deduction. What is the amount that you are eligible to? The amount that you are eligible to is the deduction of an amount equal to so much of the amount of income by way of dividends received from such other domestic company. Amount of income by way of dividends received. So here the reference is not to net dividends. Here the reference, and again the usage of the word received. So here they are talking about dividends received. That is the second view that is possible. And hence one should be eligible for deduction under section 80M on a gross basis and not on a net basis. So these are the two views which are possible. However, in this context, and this is a very old issue, there are Supreme Court judgments on it, and we'll come to that. But there was an amendment whereby section 80AB and section 80AA were brought into the law, and 80AA was very specific to dividends, so as to clarify that net dividends is what it should be eligible for deduction under section 80M. Unfortunately, 80AA was removed. 80AB, and when you get time, I would sincerely request you guys to also read section 80AB, because it also somewhere brings about the same principle that when your deduction is such which is based on your income, the language is when your deduction is such which is based on your income, then the amount of income has to be referred to as the amount which forms part of the gross total income. And now that's why I come to the previous question again, whether it is a deduction on your income or a deduction on your distribution. If you are taking an argument that the deduction is on the distribution, then you may be able to come out of 80AB by saying that my deduction is not in respect of income and therefore 80AB doesn't apply. However, that looks a bit risky proposition to take, because as I said, the positioning of the section 80M is in part C, which talks about deduction in respect of certain income, and the starting of 80M is also referring to income by way of dividends. So deduction of an amount equal to so much amount of income by way of dividends, and therefore taking an argument that it is an deduction in respect of distribution and hence gross dividend should be allowed as deduction is a question mark, which is a question mark. What can happen here is what will happen to a case. So I'm just trying to relate it to the earlier slides. We talked about nature of income, whether business income or income from other sources. In that context, if I have to now read about the amount of deduction, see, all these amendments and interpretations are very much interlinked, and hence it is very important to continue to have our thought process on a continuous basis. See, what happens is when the deduction, when you are saying that the dividend income is your business income, the source is business, though I may be taxing it as other sources. Can you claim the expenditure in your business income? Can you say that my expenditure towards making investment is a business expenditure, and can you then take a benefit of it? So that is another thing that could be crucial in terms of interpreting. The language that is, the last point is, the language that is used is dividends distributed. So if you look at the earlier slide, they have not used the words declared, distributed, or paid. They are only referring to in respect of the amount of dividend distributed by the domestic company. So again, if one was to take a myopic view, one may say that this could interpret that only on distribution the income becomes taxable in the hands of the shareholder. But to my mind, the usage of the term distribution here means all the three: declared, distribution, or paid. what could happen in the case of section 222E? Because 222 is effectively a loan, but taxed as dividends under the Income Tax Act. So when you're talking about dividends distribution, broadly one can take a view that when there is a loan transaction, the dividend does not get covered. Dividend in the nature of 222E does not get covered by section 80M provides explanation, and therefore such dividends are out of the purview. Now, a second question. Now that we have considered the basic computation mechanism and the basic provisions around taxing of dividends, while this is not an amendment, but it will have an impact, and hence I have also tried to capture this section here. What is the purpose? The purpose is, will the amendments that have happened so far have an impact on section 115 BBD? What is section 115 BBD? Section 115 BBD talks about taxability of foreign dividends. It says that if you are meeting a particular threshold of shareholding, then your dividend income will be taxable at 15%. Now I would like you to recollect what we discussed earlier, in terms of the deduction under section 57, which used the term where the total income includes dividend. So the same language or similar language is used in section 115 BPD, and therefore how do you read that language? Do you go by the net income theory in terms of taxing dividends, or do you go by the gross income theory for taxing dividends? This is otherwise also a general question which is already there. It does not directly depend upon the dividends, but now with the amendments, what is going to happen is you will have dividends flowing in from domestic companies, you will have dividends flowing in from foreign companies. They will form part of your income. Both of them will form part of your income. Till date, only dividends from foreign company was forming part of your total income, but now all your dividends will be forming part of your total income. And with the issues that we discussed earlier in terms of section 57, in terms of section 80M, the issue for 115 BBD, whenever you have a dividend from a foreign company, is going to increase. For example, if we take the first issue, deductibility of expenditure and allowance. So section 115 BBD, if you look at the subsection 2, it says, notwithstanding anything contained in this act, no deduction in respect of any expenditure or allowance shall be allowed to the assessee under any provision of this act in computing its income by way of dividends referred to in subsection 1. So one thing is very clear, that principally, if you have dividends which you have received from a foreign entities wherein you hold more than 26% shares, in such a case, when you are finally computing your tax liability, important, when you are eventually computing your tax liability, the dividend portion will be without any exclusion of any expenditure or allowance. So section 115 BBD falls under chapter 12, which talks about special rates of tax. So we need to understand that scheme also. Section 115 BBD provides for chapter 12 provides for multiple sections, and the idea is that if a particular income is to be taxed on a gross basis, it would ideally fall under that chapter. That is the basic fundamental of this chapter. If an item of income is to be taxed on a gross basis, then it should be falling under chapter 12, and then the respective sections provide for the method of calculating your tax liability. So even 115A or 115 BBE, all those sections will fall here. So the first principle is clear, that any expenditure or allowance will not be allowed. Set off of current year losses, can you set it off? Again, it is a question mark, because the language says any expenditure or allowance shall be allowed to an assessee under any provision of this act. Here reference is to expenditure and allowance. There is no reference to losses, and hence it should be possible to take an argument that losses are not explicitly used here in the subsection, and therefore what is to be taxed is what is to be not allowed is any expenditure and allowance and not loss. So you can still set off your loss. One may, if it had been a tax officer, and of course there are judicial precedents, but a tax officer would say that the loss that has been generated is on account of your expenditure that you have incurred in a particular head. So if one has to look at the substance, it is an expenditure for which you are trying to claim a benefit, just because there is no word used in terms of loss in the subsection. However, there are other sections related to 115 BBDA and 115 BBE, which specifically use the word loss in those sections, thereby meaning that for those sections you can even not set off losses. Therefore, it may be strongly possible for a taxpayer to argue that losses should be allowed as a set off when I'm computing my income here. Brought forward unabsorbed depreciation and loss. Unabsorbed depreciation, when you bring it forward, it becomes a part of your current year's depreciation under section 32 subsection 2, and therefore it could possibly have a different implication. However, an interesting point is unabsorbed depreciation, once you bring it forward, unabsorbed depreciation becomes an allowance, depreciation allowance, and therefore now if I read the subsection 2, it says any expenditure or allowance. So if I have an unabsorbed depreciation which I have brought it forward and made it a part of my current year's depreciation, can it be claimed as an allowance and thereby not allowed for a deduction? Possible. Similar is the case for brought forward losses. Of course, you can, if you have claimed your income, only if you have claimed your income as business income, not necessarily under the head profits and gains of business or profession, then there could be a possibility of trying to get a set off for it. However, if you go by the reading that we earlier had, that the income has to be shown as dividend income and the income from other sources, there could be a large chance of a litigation, even though the nature of income may continue to remain business income. Deduction under section 80M, again there are two views. Certain sections under chapter 12 provide for a specific computation mechanism wherein deductions under chapter 6A are not to be allowed when you calculate your tax on gross basis. However, section 115 BBD does not have such a provision, and therefore one may possibly try to claim a deduction. What happens to foreign tax credit? So if one was to tax the income on a gross basis without any deduction whatsoever, either expenditure or loss or depreciation, one may be able to take a foreign tax credit. And even after those deductions and set off, if there still remains an income, one should be allowed to take a foreign tax credit. So that to my mind does not create a challenge. So what I'm trying to tell here is 115 BBD talks about a specified foreign company which has wherein you have more than 26% shareholding. So when you're referring to these three sections, section 57, ATM, and when you're also talking about FTC, the whole computation mechanism is very important to take note of. To sum up on this particular aspect, broadly, there are two possible views. First is that the total income is to be computed after set off of losses and deductions under chapter 6A, and only if after all the computation, because chapter 12, as I said, provides for a calculation mechanism. So once you, and it starts with your total income. So once you calculate your total income, and if there is a positive figure coming out of it, then effectively the question of tax would arise. A possible other argument is the intent was to provide a beneficial rate of tax, because the normal dividend could be taxed at 30%, foreign dividends could be taxed at 15%. Now, if you allow a deduction in a particular dividend and not in the other one, then it could not be sufficient for the intent. And that's why that could be another argument that one can take. Different language is what I already discussed. Interestingly, budget speech of 2020. So, as I said, when they talked about the cascading effect in ATM, they said that any foreign company or an Indian company. So they have not made it clear that it should be a subsidiary company for claiming ATM. However, the budget speech of 2020 makes a reference that in case of section ATM, the benefit is to be given in respect of dividends received from your subsidiaries. So that could go either ways for you, depending on what are you trying to claim, whether you are going for ATM or 115 BBD. So that is going to be a budget reference point, which is going to be very relevant. The other view, which is possible, is that foreign dividends are to be taxed on gross basis without any deduction whatsoever. If you look at the memorandum explaining the finance bill, when 115 BBD was introduced, it said that on gross dividends, we will tax them at 15%. So intent was always to tax the gross dividends. Plus, if you look at the ITR utility, the format of the ITR, even if you feed in the data, effectively, unfortunately, you come to a result which says that dividends under 115 BBD are to be taxed on gross basis, and you don't get a deduction in any respect whatsoever. We even tried to feed in the data, but the result that we got was that the gross amount was showing as taxable. And therefore, what is going to be very important and critical is the intent that you had while you brought in the law, the language that you have used to provide this benefit, and effectively then you take a holistic approach. And of course, judicial precedents will definitely be a reference point. Moving towards the last segment of our presentation for the day, taxing of non-residents. So when we are talking about taxability of non-residents, we are talking about two situations, section 115A and withholding tax, and we will talk about MLI. So when we are talking about 115A and withholding tax, what was the pre-amendment situation? Pre-amendment, there was a dividend distribution tax. There was a view which was possible which said that one can look at a treaty when you are looking at dividend distribution tax. However, broadly, the view that prevailed was one cannot claim a credit in respect of DDT, and in respect of the rate of DDT, there was a very limited access that one could have. So this was the pre-amendment scenario. Now the amendment that has come in, and it is very important to know the budget speech. The budget speech says that two reasons. It says that credit was not available, the reasons that I mentioned earlier. Credits were not available and DTAA access was not available in certain situations. That is the language that they have also used in the budget speech. So that is the purpose why they have brought in this amendment of taxing dividends in the hands of the shareholder. 115A taxes dividends. It provides for a tax rate of 20%. As I mentioned in the first slide, there is a corresponding amendment whereby the withholding tax rate has been brought to 20%. So there is a matching that they have done in terms of the tax rate and the withholding tax rate. In terms of the treaty access, now there is a clarity that there is no litigation around, there could not be a possible litigation around it. One can try to access the treaties, and the tax rates in the treaties could be anywhere between 5 to 15%, broadly based on our analysis. So there are certain treaties which provide for generally 10 to 15% tax rate. There are a few treaties, around 3 or 4 treaties, which provide for 5% tax rate when you're looking at dividend. Now, definitely this is a very useful thing for foreign investors because they will start getting credit also. Plus, the dividend tax rate for them becomes very less, and a lot of companies exempt dividends. So the effective tax rate in India, if it is 5%, could come down drastically. What is the impact of MLI on this? Because MLI will have an impact on how you are taxing dividends in the hands of the shareholders. So Article 8 of MLI provides for a change to your treaty. It will not. So your treaty will have to be read with Article 8. It provides for an ownership condition. So as we know, when you just broadly say, there could be treaties wherein you have a direct access to the treaty and there is no requirement of participation exemption. There could be treaties wherein there could be participation exemption depending on the voting power or the shareholding, etc. What the MLI does is, in respect of such treaties which have a participation exemption clause, very important, only those treaties which have a participation exemption clause, this Article 8 would apply in those cases. What does the Article 8 say? It says that there should be ownership conditions, and the ownership conditions that are there in a particular treaty have to be met throughout a 365-day period that includes the day of payment of dividend. So till now, because of DDT, the MLI, the document was submitted last year, but not much relevance was given to this particular article. More so because we were under the DDT regime, and hence now it becomes all the more relevant to take a relook at that provision. So it says that if and only if you are meeting the threshold that is prescribed in a particular treaty throughout a 365-day period, which also includes the day of the payment of dividend, then and only then you will be eligible to claim the treaty benefit. As I said earlier, it is applicable to treaties that currently provide for a participation exemption, and hence there are a lot of treaties that do not provide for a participation exemption. The benefit of lower rate of tax or source-based limited taxation is also allowed otherwise in a lot of treaties. So those treaties will not be applying this article. The article says that the country needs to specify the treaties to which it wants to make this article applicable. what eventually, before we look at the India's position, I could have changed the flow, but I thought I'll first discuss about the principle. The principle is, now, as you know, in terms in India, when you're looking at a withholding tax from the payer's perspective, earlier we had no recourse to a treaty, honestly speaking, and if at all one was to take an argument of a treaty benefit based on certain readings of a treaty, then in that case, TRC and beneficial ownership were the two major criteria. And of course, wherever there was a participation exemption, the proof of being a owner of that percentage. What happens post amendment? Post amendment, as a payer, I need to take a declaration. That is all that a payer can do. He cannot go and verify. That is going to be very difficult. But he has to take a document from the recipient saying that during the 365-day period, he was fulfilling the ownership condition. Why is it going to be practically challenging? Is the MLI does not say prior to the date of dividend. It does not say 365 days prior to the date of dividend. It says 365-day period that includes the date of payment of dividend. And therefore, if the date of payment of dividend is today, and why have to calculate 365 days? It could be prior or it could be post. Now, how can somebody give a declaration or a clarification that he is going to remain the owner for the upcoming period of 365 days? So practically, this is going to be a bit of a challenge, is what I sense. Now, however, do we have a lot to worry? So broadly speaking, India's position is that India will apply Article 8.1. In respect of the treaty with Portugal, India has made a reservation because India already has an article which says that you have to satisfy 24 months criteria and not 365 days. So it is a more stringent criteria, and hence India has reserved its right. This is interesting because the 24-month criteria is in respect of dividends. The 24 months criteria is prior to the date of dividends and not post. And still India has brought in a reservation. Does that mean that the language that we read earlier throughout a 365-day period that includes the day of the payment of dividend, does it mean the pre facto period of days? A possible interpretation, I would not deny. India has notified 24 treaties. The 24 treaties, in those cases, India would like to make Article 8.1 applicable. So what is the current situation? With 9 out of such treaties, India does not apply MLI in that case because either those countries have not notified India for this particular article, and in case of Mauritius and Oman, they are not a covered tax agreement, and therefore these provisions will not apply. For Mauritius and Oman, currently they are not a CTA, but even if they were a CTA, they have not applied Article 8.1, and hence it will be out of it. There are certain countries which have not deposited instruments but are mentioned in India's MLI position. So there are 11 such countries for whom again existing provisions will continue to apply. MLI will apply only in 4 countries. So a breather for a lot of our clients and for us also. Broadly speaking, only in respect of 4 countries: Canada, Serbia, Slovak Republic, and Slovenia. These are the 4 countries on which you will apply the MLI provisions. And for all others which are not notified, around 65 of them will continue to apply the existing provisions. So more or less, apart from the 4 MLIs or 4 treaties, the existing provisions shall continue to apply as of now. Only for the 11 countries, once they submit the instrument, what do they do on Article 8 is something that needs to be seen. Just one example here, we are talking about Slovenia and Slovak Republic. So I sense that one of these treaties has a 5% tax rate for dividends. So if one had to take the benefit of MFN in a particular country, say Netherlands for that example, and one was to apply the MFN and go to the treaty of Slovenia or Slovak Republic in order to bring the tax rate down to 5%, then how does the MLI come into picture is what one needs to see. So can one directly apply the MFN clause in that sense is a question. Now, okay, so these were broadly the situations under MLI, because I think the team wanted me to just take them through the MLI situation. As I said earlier, I did not want to distract the discussion, nor did I want us to get biased by the judicial precedents. But for the benefit of all, what I've done is I've tried to bring up some precedents on each of the aspects that we have discussed. So, for example, when we were talking about trigger of taxation, as to what could trigger taxation, there are Supreme Court judgments in the case of Purushottam Das Thakur Das. There are judgments. There is a judgment in the case of J. Dalmia, and there are Bombay High Court and Mumbai Tribunal judgment in the case of Lakshmi Das and Pfizer. So, effectively, what I would like to just summarize in terms of the judgments that have been brought in is that when you are talking about declaration or distribution, these judgments of the Supreme Court also affirm the view that the trigger point is going to be declaration unless the distribution or payment is going to be contingent in nature, and therefore this is of course in the old regime. However, it is going to be equally relevant. So Khatau's judgment is very clear. Khatau's judgment is very small, but it is very clear that declaration tantamounts to taxability. Purushottam Das, it was a contingent payment, and therefore it was held that once the payment is contingent in nature, it cannot be taxed. In Dalmia also, it was interim dividend, and in case of Dalmia, it was held that in case of interim dividend, unconditionally made available to the shareholder, what we read in the initial slides, unconditionally made available will happen only when you effectively pay the dividends. So that is going to be very relevant for interim dividends. Now with the classical system again coming back. Then when you're looking at strategic investments, whether it should be business income or taxable under the heads PGBP or should be taxed as other sources, there's a recent judgment by the Chennai bench of tribunal which says that the investments are very strategic in nature. So here also I would like to differentiate that the facts of the case were such which could differentiate themselves from a case where I am investing in my subsidiary, and therefore how much one can rely upon this judgment is going to be a question. However, there is a favorable ruling that is currently available by the Chennai bench. Section 115 BBD, whether it should be taxed on gross basis or one can take adjustments or deductions from it. Again, there is a recent judgment in the case of Tata Motors by Mumbai bench, wherein it has been held that the total income phrase used in the section 115 BBD has to be read as per the definition given in section 2, and therefore after all the deductions including chapter 6A and the losses, you are allowed to tax the gross dividends, and therefore the tribunal allowed set off of losses from the gross dividends. So this is going to be an important judgment if one has to rely upon it. In terms of deduction under section 80M, whether the deduction is to be done on a gross basis or a net basis, the first two judgments are landmark judgments. Cloth Traders was the first such judgment, while I mentioned it second, but that is the most critical judgment. Because it was a Supreme Court ruling and it was in favor of the assessee, saying that the gross dividends is what one can claim deduction of. And then there was another Supreme Court judgment in the case of Distributors Baroda Private Limited, which was a larger bench, and the larger bench nullified the Supreme Court judgment in the case of Cloth Traders, so as to say that deduction under section 80M has to be allowed on a net basis, that is the amount of income which is effectively forming part of GTI. It was post these judgments, or in fact pre these judgments rather, that the amendments somewhere near around that the amendments were brought in, and section 80AA and section 80AB were brought in. As regards whether the expenditure should be claimed under section 57, so one of the arguments that we discussed was, can one take a plea that the expenditure that I have incurred is not for earning dividend income, it is actually towards my business, and hence I will be claiming it under 3613 and not under 57. There are judgments on this, wherein high courts have, in fact, 3 high courts and 1 special bench. The special bench judgment is very nice, and it's a very well drafted judgment. The majority view was very lucidly explained, and so I think one should read through it. The other 3, Gujarat High Court was in favor. It said that the tax officer cannot assume a number in order to go for a section 57 expenditure, so that he can curtail the deduction under ATM. Similarly, in the case of Reliance Industries, in Hero Cycles, the view was different. In Hero Cycles, the Punjab and Haryana High Court said that if the assessee is not able to substantiate that he had not incurred that expenditure for earning dividend income, then in that case the officer has a right to make a proper estimate and thereby not allow the deduction under section 80M. So these are broadly the judgments which I thought, of course there are many more judgments, but these judgments were something that I had referred, and I thought I'll just bring it for everybody's reference. So I think one of those last three High Court judgments, there is a leave that has been admitted by the Supreme Court. I will check on that, but yes, as of now the way they stand is like this. So these are the judgments. So to sum up, the three major issues that we are currently facing is whether dividend should be taxed as business income, PGBP, or as income from other sources. Claim of expenditure could lure taxpayers to take a particular position. Deduction under 80M, gross versus net, and taxability of foreign dividends. So these are the three primary points that I thought will be very important in the future, because I see a lot of possibility of litigation around it. While there are precedents available, thankfully, because there was already a classical system of taxing dividends, but I think this is here to stay unless CBDT comes up with a circular. Else we'll again go back to the old judgments and again have litigation which may attain finality some 20 years down the line. So with this, I think I'll end the topic. I hope I've invoked enough thoughts amongst the audience with a lot of technical discussion. Again, as I said, the idea was, while we have definitely come to some conclusions in some points, but the idea was to have a new thought process, a completely different thought process, not getting carried away by judicial precedents or the DDT regime, and have an application of mind which is completely new and fresh in terms of understanding the interpretations coming out of the new dividend taxation regime. With that, I thank you all. I hand it over back to Yash and team. Thank you.
Yeah, thank you, Dhaval bhai. It was a wonderful session. I guess you have covered comprehensively everything. Should we take a couple of questions that has come on the chat box?
Sure, we can.
Yeah. So first question is, what is the difference between address taxable under IFRS and taxable under PGBP?
Okay. So is that Parag?
Yeah.
Okay. So Parag, see, what happens is when you are talking about taxability as income from other sources, and that is why special bench judgment by Chandigarh bench is very important and nice to read, because you will also get the minority view and you will also get the majority view. And at length, they have discussed this broad philosophy of what should be taxed under what head, even if it is a different source. So there has to be a differentiating factor as to whether a particular income falls under a particular head of income. As I said, my understanding says that dividend income will always be taxed as income from other sources, though it may be arising out of the business of trading of investments that I may be carrying on, or to an extent strategic investments. But as I understand, dividends will ideally always be taxed under section 56. And once it is settled that dividends are taxed under section 56, taking a claim for the expenditure part of it, saying that the expenditure was not related to dividends but was related to my business, could become a bit tricky. I'm not completely negating it, but if one had to take an argument, one could say that, as I'm just thinking, one could possibly say that the expenditure that I've incurred for managing my investments, or the expenditure that I've incurred for investing into a particular share, is for multiple purposes. Dividend again is just a part of it, and therefore a major part of my expenditure should be allowed to me under the head profits and gains from business or profession, and it should not be considered for section 57. However, I'm sure there is going to be a lot of questions from the tax officers on this.
Yeah, very interesting. We have another question from Mr. Varatharaj. Say, for example, 115 BBD dividend is 100 and ATM deduction is 100. In this scenario, can FTC paid can be claimed considering the income is included in gross total income?
A very dicey situation, to be very frank. There is no clear answer. However, primarily, if you ask me, if I had to, so there are two assumptions that we are making here. The first assumption is that there is a dividend income which I have, which is not being taxed, from which I'm getting a deduction under ATM, if I may put it that way. So one has to also make an assumption as to what all other incomes do you have. So if you have other incomes, one may try to possibly take an argument saying that the deduction under section 80M is not akin to deduction under section 57, and therefore the deduction is a deduction from the overall income. It is not a deduction which is income specific, and thereby I may try to take an argument of claiming FTC even in that case. On a gross basis, if I was taking a view that income has to be taxed on a gross basis, there was no challenge whatsoever. But even in this case, now, as I think, I possibly see a chance to claim FTC, saying that the deductions under Chapter 6A are of a different character as we compare it with Section 57.
Understood. So one of the connected questions is that, do you have an option to go around between ATM and FTC? Can you jump your gun around this? Or is it mandatory to claim ATM and then not claim FTC if the most conservative view is taken?
Correct. So if one has to take the most conservative view, see the question that you have put forth, if I have to reword the question, are deductions under Chapter 6A mandatory or optional? So there have been cases wherein it has been held that once there is a provision in the law, then it has to be given effect to, if not by the taxpayer, then by the tax officer. So if we go by that principle, then ATM becomes mandatory. However, as I said, because there are multiple computations possible, broadly speaking, one without ATM, one with FTC, one without set off of loss, so that I can take it forward to the next year if I'm envisaging more income in the next year. So as an assessee, if there are permutations and combinations possible, I think a beneficial provision, adopting a beneficial proposition could be a possible scenario one can evaluate.
Okay. Next question is from Ambuja Sharma. Ambuja, you can raise your question.
Thank you, Prateek, for giving me the chance. Hi, Dhaval. My question is regarding the MLI provision. As we can see, due to the change of the dividend regime in this scenario, it might be possible that companies might take the advantage of treaties, and there are only limited countries with which MLI provision apply. In that scenario, is it possible, or would it be possible to apply the GAR? And what would be the impact in that case?
Sure. I think this is a very interesting point that you brought out. While I was making that slide on MNI, I had that question. Before jumping into GAR, the next step could be whether there is a principal purpose test. If there are countries with which, while I may not have notified Article 8.1, but with which I may be applying my principal purpose test. In case of such countries, first there could be a possible risk of principal purpose test. If that arrangement is such in order to get more benefits because of the lower tax regime, then that could first come up. Second is when you're talking about GAR. Now if we are talking about a situation wherein the investments have been made much prior, then in that case applicability of GAR would be out of question, broadly speaking. In case of new investments, if I'm doing it now, with a country with which I either do not have an MLI or which does not have a principal purpose test, then definitely it could be worth a challenge, unless you are able to demonstrate that there was a commercial reason for entering into a particular treaty country or flowing your investments through a particular treaty country.
Yeah, thank you. Thanks a lot.
Sure. Next question is, okay. So next question is relating to on taxability of dividend. Wouldn't we consider the record date for determining the year in which the dividend will be taxable in the hands of recipient?
Okay. So see, there have been case laws wherein even these aspects have been discussed. So if I tell you this way, in the 1922 Act, where the word used was paid. So the only word that was used was paid, and therefore there was a lot of litigation around it. In the context of that section, there were a couple of judgments wherein record date and the date of share warrants, dividend warrants, sorry, pardon me, were critical criteria to determine taxability. However, in the new act with section 8 very clearly mentioning 3 elements of declaration, distribution and payment, I think declaration would be the trigger point. So the annual general meeting and the annual general meeting wherein the dividends are declared would become the trigger point.
Okay. Next question is from Nikunj. Nikunj, you can raise your question. You can unmute yourself. Okay, I will read it out.
Sure.
When dividend is specifically included in section 56, then considering it as business income under PGBP, is it not against the law itself? And second, in case the dividend is considered as business income, will the investment be considered as business assets and no capital gain benefit available?
See, when we are looking at investments and dividend income, as I covered in my slide earlier also, if first I'll look at section 56. So as I discussed, there is a specific subsection and a clause under that subsection which provides for dividend taxability. So in all probabilities, dividends should be taxed as income from other sources. However, there have been recent judgments wherein dividend income has been taxed as profits and gains from business or profession, and I'm equally aware about it. And see, there could be an argument if I am the taxpayer and if I wanted to take it under PGBP, what was the argument that I could have taken? The argument that I could have taken was section 56 refers to those investments which are like completely passive investments and I'm generating an income out of it. However, when I have an active investment where I have a day-to-day role to play and in terms of the strategy building and all, then in that sense it is my day-to-day affair, and because of my inputs there are rewards that are getting generated, and hence dividend is attributable to my active efforts. And hence once that active activity comes into play, one may try to possibly argue that it should be taxed under PGBP, but as I discussed during my earlier part, the way the law is drafted as of now and plus the judgments that I refer towards the end, it is difficult that it will pass the test of litigation if one had to do it, because the judgments also very clearly discuss this aspect, that while it may be a business income, but it may still be taxed under income from other sources. What benefit do you have if you are able to substantiate that it is a business income? For let's understand that for a moment you are taxing it as income from other sources. The benefit that you could still get is you may take it as a business income, and when you're looking at a set of losses, the language used in that section is that income, the losses could be set off against income, profits and gains of business or profession, but it does not say under the heads business or profession. So even if you tax it as IFOS, but if you are able to substantiate that in substance the source of income was business nature, then you get that additional benefit out of it. Same would be the case for investments also. So if the investments were like today, if you're talking about dealers who are trading in shares and securities, it ideally becomes their business income. So that continues to remain your business income. That's how I would like to put it.
Okay. One last question. It is from Mr. Chintan Gajjar. What would be MAT implications of dividend on 115JB, more particularly considering ATM?
Just a minute. So we are saying that for the purpose of MAT, it will become my taxable income. So if I am the recipient of income, MAT continues to apply because income will become part of my book profits, and I continue to pay tax on it. I think that's quite simple.
Okay. Okay, I think we have taken up enough questions.
Sure.
So with this, I would now request Mr. Parag to provide vote of thanks to the speaker.
Yeah, sure. Thanks, Pratik. So excellent session by Dhaval bhai. I mean, fantabulous. Thank you so much for this valuable webinar. And to all who doesn't know Dhaval Bhai personally, he is not only a great faculty and a speaker, but a wonderful personality. And we have our own occasion to discuss on certain things. And we were lucky to have him today. And Dhaval Bhai, on behalf of all participants, thank you for not just giving snorkelings, but a scuba diving for this ocean of interpretation.
Thank you very much, Parag. I don't know if I deserve those words that you just mentioned, but the overall idea of this session was to just ensure that all of us should dive deep into that ocean. No one knows what's the destination, but at least we'll know the process of sailing through the ocean. That was the whole idea. Thank you very much, everyone.
Sure. Thank you,
Thanks,
sir.
guys.
Thank you, everyone.
Thank you, Dhaval bhai. It was wonderful to
Thank you.
listen to you.
Look forward to
Wonderful.
speaking
Thank
more
you.
often. Yeah. Thanks. Bye-bye.
Thank
Yeah,
you.
definitely.
Bye.
Thank you.
Thank
Thank
you.
you. Thank you all the participants.
Thank you.